90% of traders who blow their accounts have exactly one thing in common. It's not that they picked the wrong stocks, it's not that they didn't have a strategy, it's that they never, not once, wrote down what they did, why they did it, and what went wrong. They just kept guessing over and over again, and they wondered why nothing ever changed. Today I'm going to show you the single most powerful habit that separates consistently profitable traders from everyone else. It's called a trade journal. I'm going to show you exactly what it is, why it matters more than an indicator or a strategy you will ever find. And I'm going to walk you through building one from scratch, step by step. And if you stay to the end, I have got a complete free template for you. If you just drop a DM on my WhatsApp or a Telegram, I'll send you that sheet in reply. Let's get into it. So, first, what even is a trade journal? At its most basic level, a trade journal is a record of every single trade you make. But here's the thing, it's why more than just a spreadsheet of numbers. A trade journal is your personal feedback loop. It's a difference between practicing and actually improving. Think about it in this way. Imagine a golfer who plays 18 holes every single weekend but never films their swing, never reviews their shots, never tracks which holes they consistently mess up. They'll play for 10 years and barely improve. Now imagine a golfer who records every shot, reviews their game after every round, and identifies exact moments their technique breaks down. Same amount of time, completely different results. Trading is identical. Now, I want to be honest with you. When I first heard about trade journaling, I ignored it for months. And I think most of you watching this have done the same thing, or you are doing it right now. So, let me tell you the three reasons traders skip journaling and see if any one of these sound familiar. Number one, it feels tedious. You just made a trade, it's done. You want to move on. Waiting it all down feels like homework. Number two, overconfidence. When you are on winning streak, journaling feels unnecessary. And when you are losing, the last thing you want to do is look at your mistakes. Number three, you just don't know how. Nobody teaches this. No trading course I have ever taken spent more than 5 minutes on it. If any one of those hit close to home, this video is exactly for you. Let's keep going. Let's keep going. All right. Let me give you 5 concrete reasons why a trade journal isn't optional if you are serious about trading. Reason 1, you stop repeating the same mistakes. Here's a brutal truth. Most traders don't lose money because of bad luck. They lose money because they make the same mistake over and over without realizing it. Maybe you always exit too early when a trade is working. Maybe you revenge trade after a loss. Maybe you always overtrade on Friday afternoons. You don't see these patterns unless you write them down. Your journal makes the invisible visible. Reason 2, you discover your best setups. Every trader thinks they know what works for them, but most traders are wrong. When you have got 6 months of journal data, you can actually look back and see, okay, my win rate on morning breakouts is 68%. My win rate on reversal plays is 31%. Suddenly it's obvious. You do more of what works, you cut what doesn't. You build what professional traders call a playbook, a curated set of only your highest probability setups. Reason 3, you develop genuine emotional discipline. Reason 3, you develop genuine emotional discipline. Most trading losses aren't because by strategy failures, they are caused by emotional decisions. Holding a losing trade too long because of ego, entering too large because you are feeling overconfident, freezing up after a bad week. When you write down your emotional state of every single trade and then look at data, you will see the connection between your emotions and your results with absolute clarity. That awareness alone is transformative. Reason 4, you finally see your real numbers. Here's something uncomfortable. Most traders have no idea what their actual win rate is. They have a feeling about it, and feelings are always wrong. Your journal gives you hard data, real numbers, win rate, average risk to reward, max drawdown, best day of week, best time of day. You start trading like a business, not like a casino. Reason 5, and this might be the most important one. You grow faster with a journal than with any paid course, any mentor, any indicator, because the journal forces you to learn from your own trading, not someone else's theory, not backtested data from a different market regime. Your results, your mistakes, your growth. No course can replicate that. Okay? Now let's build one right now from scratch. All right, I'm going to walk you through the exact template I use. I'm using Excel sheet here, but everything I show you works in Notion, Excel, Google Sheets, or even a physical notebook. And remember, and the free variant can be obtained by dropping a direct message to my WhatsApp or Telegram. You will get in reply. You can grab it right now and follow along. Let me walk you through every field and explain why each one matters. First, date and time. Not just the date, the time as well. Why? Because you might discover you are much better trader in the morning than the afternoon. Or you always make bad decisions in the last 30 minutes of the session. Time of the day is one of the most underrated performance variables. Next, ticker or asset. This tells you which market you trade best. Maybe you think you trade everything, but your data shows you consistently losing money on crypto and consistently profit on large cap equities. Know your lane, direction, long or short, simple, but it matters. Some traders are naturally better at reading bullish setups than bearish ones. Your data will tell you entry price, exit price, position size. These three together give you actual profit and loss for each trade, not an estimate, not a feeling, the real number. And position size is critical. It tells you whether you are sizing consistently or whether you are betting big when you feel confident and small when you are scared. Setup type. This is where your name, the pattern or strategy you used, breakout, pullback, to move an average, or whatsoever, earning gap, whatever your vocabulary is. Use it consistently. Over time, this is what lets you filter your journal and see how does my breakout strategy perform compared to my pullback strategy. Planned risk to reward. Before you enter any trade, what was your target and what was your stop loss? Was it 1 into 2, 1 into 3? Writing this down holds you accountable to your plan. And when you compare planned risk to reward versus actual outcome, that's where you learn the most. Emotional state. This is the field most people skip. Don't skip it. Rate yourself on a simple scale: calm, neutral, anxious, overconfident, revenge trading. One word is enough, but do it every time. In 3 months, when you filter your journal by emotional state, you will see the direct relationship between how you felt going into a trade and how it turned out. This field alone has saved me from hundreds of bad trades. Pre trade notes. Your thesis going in. Why are you taking this trade? What's the catalyst? What needs to happen for this to work? Writing this down forces you to think clearly before you enter. It's natural filter against impulsive trades. If you can't write a clear thesis, you probably shouldn't be in the trade. Post trade notes. Your honest review after it closes. Did you follow your plan? If not, why not? What would you do differently? This is where the real learning happens, not from wins, from honest post trade reflection. And finally, you are running equity curve. This is a chart of your cumulative profit and loss over the time. This is your report card. It tells you instantly whether your overall system is working and whether you are trending in the right direction. When this line is going up and to the right, you are doing something right. When it starts flattening or dropping, something needs to change. Don't look away from it. That's a code template, 6 to 10 fields. That's all you need to start. You can always add more complexity later, but for the first 30 to 60 days, just consistent with these basics. Building the journal is step one. But the review process is where the magic actually happens. Here's the weekly ritual I would recommend. It takes about 20 to 30 minutes once a week. I do mine every Sunday evening. Step 1. Look at your equity curve for the week. Is it up, down, flat? How does it compare to previous week? No emotional reaction, just observation. Step 2. Filter your trades by outcome. Look at your losers first. What do your losing trades have in common? Same setup, same time of day, same emotional state going in. Find the patterns. Most traders have one or two recurring mistakes that account for the majority of their losses. Step 3. Look at your winners. What's your best performing setup type? Your best time of day, your best market conditions. This is how you build your playbook, by doubling down on what's actually working. Step 4. Set one intention for the coming week, not 5 goals. One thing. Maybe it's I will not trade after 2 p.m. I will only take A grade setups. One focused intention consistently applied compounds dramatically over time. Before I let you go, let me hit the most common mistakes I see traders make with their journals. Mistake 1. Only logging your winning trades. This is the most common one. You feel good after a win, so you write it down. You feel embarrassed after a loss, so you skip it. The losses are the most valuable entries in your journal. Log every trade, no exceptions. Mistake 2, skipping the emotional state field. I already mentioned this, but I'll say it again because it's that important. Your emotions are part of your trading system. Treat them like data. Mistake 3, building a system that's too complicated to maintain. I have seen traders with 40 column spreadsheet they filled in for 2 days and then abandoned. Complexity is the enemy of consistency. Start with 6 fields, build the habit first, add complexity only when the habit is locked in. Mistake 4, reviewing too infrequently. Some traders do a journal for 3 months and then do one big review. By then, the patterns are too far in the past to be actionable. Weekly reviews keep the feedback loop tight. Small adjustments compound. And a couple of pro tips before you wrap. Take screenshots of your chart at entry and exit and attach them to your journal entries. When you review them later, you will see things you couldn't see in the moment. And use your journal when you are in drawdown. That's when most traders stop journaling, right when they need it the most. The journal isn't just for good times, it's your anchor when everything feels like it's going wrong. All right. That's everything you need to start your trade journal today. You don't need a fancy platform. You don't need expensive software. You need a spreadsheet. 10 minutes after every trade and 20 minutes every Sunday. That's it. The free template I walked you through today, I have given you how you can get it. Just have it and start filling it in from your very next trade. One question for you. Drop your answer in the comments. What's the one trading mistake you keep repeating? Seriously, write it down because the first step to fixing a problem is acknowledging it. And your journal is where you do that. If this video helped you, hit the like button. It generally helps more traders find the content. And if you want to go deeper on the trading fundamentals or technicals I covered today, you may directly reach out. Reach out to me. All my contact details are given in the description. I'll see you in the next one.